What if I told you that there is a legal tax strategy that could put $200,000 or more back in your pocket this year? And yes, I did say it's legal, and it's meant for people with commercial real estate, residential real estate, anything that's worth over $1 million. I'm talking to you. And the strategy I'm talking about right now is called the cost segregation study. Have you heard of it? Maybe. The shocking thing is 90% of real estate investors have not heard of this thing. If you own commercial real estate or residential real estate, the next 15 minutes could really change the way your cash flow looks. My name is Ryan. Thanks for joining me again today. Today we're going to deep dive into cost segregation studies, how they work, what they are, what you need to do to qualify for this benefits, all the things that are required to basically implement this strategy, and some asterisks too. So there's some things that you need to really consider to make sure this actually will work for you. This will not work for everybody. Okay, even if you own real estate, you need to qualify for some very specific things, but we will go over all of that in this video. Also, stick around to the end because I will walk you through a real world example and show you how one instance of this can get you a $600,000 tax deduction, in which case lead to a $200,000 tax reduction. That means money back in your pocket. But before we jump in, just a quick question. Do any of you own real estate? Drop me a comment down below. I'd love to hear from you and to see who I have watching my videos and what kind of level of real estate investors they are. All right, so let's start with what cost segregation is. So what is it? Well, basically, when you buy real property, like a commercial property or a residential rental property, you probably have heard of what's called depreciation expense. The IRS lets you depreciate real property over time. Usually, if it's a residential property, the IRS lets you depreciate that property over 27 and a half years. If it's commercial property, it's 39 years. Now, that's not super exciting. You spent $2 million on a commercial property, and you can take about a $50,000 tax deduction every year on the depreciation of that property. That's pretty standard. It's standard, but not sexy. So what cost segregation study is that it's a study that lets you break down your building into different components that lets you accelerate the depreciation of some of those components. So for a commercial property, let's say you have like certain flooring or commercial equipment or light structures, lighting structures, doorways, these things that could be broken down into shorter depreciation periods. Instead of 39 years, you'll be maybe depreciating some over 3 years or 5 years. But it doesn't stop there, because thanks to the one big, beautiful bill that was passed, bonus depreciation is back up to being a big thing, 100%. What that means is if you have property that's a 3, 5, 7, 10 year, anything under 15-year property, you can take 100% of those costs immediately as bonus depreciation in the first year. That means that even if you're accelerating depreciation on some of these things, you don't even have to wait 3 years, 5 years. You just take it all at once. That's the power of cost segregation. That means you might be accelerating 20 to 35% of the cost of your building immediately and taking that as a deduction immediately while depreciating the rest of the costs over time. The study itself is the process of having proper engineering people and professionals come and look at your building to actually prove out the different components of your building in order to report it on the tax return properly. Now you might be thinking, this sounds great, but will this actually work for me personally? Well, there's a couple things to think about here. One is, if you are somebody who owns residential rental properties and you think a cost segregation study might be a good fit for you because you can take a huge deduction on your property against your other income, you should probably wait a second, because by nature, residential rental properties that are long-term or commercial rental properties are considered passive activities. That means that you generally cannot take passive losses against your other forms of income. Now, this does not apply to you if you're a real estate professional and you meet the actual qualifications to be a real estate professional. Don't just play around with words here on your tax return. You should actually meet the qualifications to be a real estate professional. But if you have like a regular job as like a accountant or an engineer or something, and you have a few rental properties on the side, you likely don't qualify as a real estate professional. So I would really consult with your tax professional to make sure a cost segregation study makes sense. Now, if you have short-term rentals, these are Airbnbs, Verbos, whatever the hell they're called. If you have short-term rentals, this is a slightly different story, because short-term rentals follow a slightly different rule to be considered non-passive. The only requirements for short-term rentals is you have to be working in the short-term rental for each property 100 hours out of the year. 100 hours, if you're managing your own property, you could probably accumulate that pretty easily. For long-term rentals, it's actually going to be more like 750 hours for the year. And not only that, you have to be spending more time in real estate than any other income-generating business or job that you have. Just to say that before you do anything, consult with your tax advisor. Make sure that it makes sense, given your interest in real estate, your activities in real estate, your other sources of income. Make sure it makes sense first before you go and jump off and start doing a cost seg. Okay? Take this from me, who takes like passive and non-passive activities very seriously. It's nothing to mess around with, because it could really get the IRS on your ass if you're claiming a real estate professional when you have a completely full-time job doing like engineering work. That's going to trigger some stuff there. So don't just jump into this. Consult with a tax professional. Reach out to us if you don't know, and we can help guide you through that. But let's say you do meet these requirements. What are the kinds of buildings that you should be considering? Well, one are commercial office buildings. These are perfect because there's a lot of different light structures. There's different things are always improving all the time. There's tenant improvements, renovations done. There's lots of things to break out into compartments here, into quicker depreciating assets. Another type of building that you should be looking for are apartment buildings. So once you start breaking over like 20 units, then there's a lot of things here to consider. Appliances, carpeting, flooring, cabinetry. These things that could be broken down when you have a lot of units could really make sense for cost segs. Retail centers and restaurants, man, these are just a plethora of commercial assets that could be, broken down. You have commercial equipment, kitchen equipment, appliances, lighting structures, electrical structures, flooring, these types of things, perfect for cost segregation. And then obviously medical, dental offices, these offices with a lot of technology in them, a lot of high cost technology and equipment would be ideal for cost segregation studies. Okay, so let's say you meet the criteria, it does make sense for you to do a cost seg study. You have the proper buildings to do it. Now, what does the actual process look like? Well, a lot of typical CPAs don't do these cost seg studies in-house. I mean, our firm does not do these in-house. We refer out to specialists that do this. And so what they do is you give them the address, you give them the depreciation schedule, and what they do is they look at your depreciation schedule and they do an initial feasibility analysis and a feasible benefit analysis, just to kind of quickly estimate, okay, we think in ballpark you might get a X amount of tax deduction immediately. These initial estimates are fairly accurate, especially if you work with people who are good at doing cost segs. But it's just to give you an idea of okay, we think we can get you this much of a deduction, and this is our fee to do it. That way you can weigh the cost benefit analysis of actually doing a cost seg for this particular property. Then if you decide you want to work with them and to follow through with the study, you would pay them, and then they will send out an engineer or somebody to look at your property in person. They'll take pictures, they'll look through your property, the inside, the outside, they'll write down a bunch of stuff, then they'll draft a report for you, breaking down 3-year, 5-year, 7-year, and 15-year property in your building. And they'll also break down lands and, the 39-year property or 27-year property, depending on if it's residential or commercial. But basically, you're going to get this long reports that basically just says, okay, this dollar amount is actually 3-year property, and this is what it's made of. Cabinets and doorknobs and all this shit, right? These are 3-year properties. Then you have 5-year property, and so on and so forth. This whole process probably happens in like 4 or 5 weeks from engagement. So if you're able to, move forward with engaging with a firm, the study might take 4 to 5 weeks, maybe 6 weeks, something like that. But here's the thing that you may not consider. You could do these retroactively. So if you bought a building last year in 2024, and let's say now we're in 2025, and you didn't do a cost seg in 2024, but you want to still take advantage of the deductions, you can still do it in 2025 for that building that you bought in 2024. You still get a major tax benefit. If you're doing it retroactively, your accountant, your CPA, your tax preparer would need to file something called Form 3115. It's a change in accounting method because you're changing the way you're depreciating your property. Okay, if you don't, it's likely that this form will need to be filed either way, but especially so if you've already started depreciating a property and now you're going back and changing the way that you're depreciating it. 3115 is definitely required to be filed with the IRS. This works even if you bought the property a while ago. Let's say like 3-4 years ago. You don't have to go back and amend each year up to now. You can actually catch up and take all the depreciation you would have taken 3-4 years ago, all in the current year. So that's why cost segregation is such a powerful tool. All right, now let's walk through real world numbers. Okay, so let's say you purchased a commercial office building for $2 million in 2025, and we have to break apart the value of the land in the building. So let's say the land is worth $400,000. That's 20%, and the building is worth $1.6 million. We break this out because land does not depreciate. Okay, so without cost segregation, you are going to take $1.6 million. Depreciate it over 39 years. That gets you about $41,000 of a tax deduction per year. If you're in the 37% federal tax bracket, that's about $15,000 in taxes saved annually, which is not bad, but check this out. Cost segregation. So the engineering team conducts their analysis, and let's say they identify $240,000 worth of 5-year property, $160,000 worth of 7-year property, and $200,000 worth of land improvements. This could be like a parking lot, parking structure, landscaping, exterior lighting, all that stuff. And let's say they identify $1 million left over as, 39-year property. That means they've reclassified $600,000 worth of assets to accelerated depreciation. That's about 37.5% of the building value. Now, because of the big, beautiful bill, bonus depreciation comes into play. You don't have to depreciate the 5-year property over 5 years or the 7-year property over 7 years. You can depreciate it all immediately because of bonus depreciation. That means a $600,000 tax deduction immediately, plus the regular depreciation of the 39-year building. So that gives you a total first-year deduction of $625,000 as opposed to $41,000. So side by side, without cost segregation, you're saving $15,000 in taxes due to regular depreciation. At the same tax rate, 37%, with cost segregation, you're saving $231,000 in taxes after cost segregation studies. That is significant. That is over 215K back in your pocket. That's actual money back in your pocket in this scenario. That's how powerful this study is. And this would be the same thing even if you had the building for a couple years now. All right, now let's talk about like the cost of doing a cost seg. Usually for a building over like $2 million like this, it might run you $5,000 to $10,000 to do the study, but you just save $215,000, you know? So that return on investment's over 2,000%. That's pretty crazy, right? What could you do with an extra $215,000? You know, it could be a down payment for another investments. It could be put into the stock market for, just general growth. You could pay down high interest debt. You can, build emergency funds. You could do a lot with this money. And this is the power of cost segregation. You're not evading taxes. You're using the tax law to your advantage. Now, I know what you're thinking. If you're just accelerating depreciation, you have to recapture it at some point, right? Well, yes, that's true. You do have to recapture it at some point. So that's another reason that you want to talk to your CPA, because if you plan on selling this building or whatever investment you have soon, it may not be worth your while to do this study. But if you're a buy and hold kind of person in real estate, these things make sense. And you can also further defer the recapturing of these by doing 1031 exchanges, right? So overall, the bottom line is talk to your tax professional. Make sure you get actual consulting on this before you start doing stuff, because one, you don't want to waste your money on a cost seg study that doesn't benefit you, and two, you don't want to waste money on a cost seg study if you're going to be back at the starting line anyway if you're selling the property. Thanks for watching. Please be sure to subscribe if you found this video helpful, and give this video a like. Also, share this channel, this video with your friends and family that you think might find it helpful. I'd really appreciate that. Thanks for tuning in today. I'll see you next time.